was an interesting month this month with the reporting season in Australia, which started to see quite a range of deviations in the different sectors across the market here. And some of that was stock specific led, but also a bit of a valuation rotation as well. If we look at some of the sectors specifically, so resources had a really good month, up about 9% for the month, compared to the market, which was up sort of 2 to 3%. And on the flip side, healthcare was down 13%. Resources generally was up higher because of better results from the likes of BHP and Rio Tinto, which saw still quite strong production outputs and higher commodity prices than probably what was expected from the market. On the flip side, CSL as a standout, and there were a few other standouts as well in what was quite a volatile month. CSL had an announcement that the market wasn't that comfortable with, and a bit of uncertainty that was introduced with the intention of splitting a business up into two different ASX listed businesses. But the growth also didn't hit what the market was expecting. I think it hit sort of a 7 or 10% profit growth number, and they've talked about some restructuring and obviously that delisting or separation, I should say, of the business, which has created some uncertainty as to what the outlook of the company is and whether the company has got all of the costs and outlook under control. So that's one that was of interest in the month. As we've been alluding to, reporting season does lead to volatility in markets, and it's more so company-specific volatility rather than market-wide volatility. And you can see the deviation between the materials sector and the healthcare sector, and there's a smattering clearly of the other sectors in between, but there's a 20-odd% difference between the best performing sector and the worst performing sector. Now, some of those, as we mentioned, is company specific, and you have a look at some of the other results in different sectors, and there were companies that were moving in the order of 20 to 30% on a single trading day. Now that's risky, and some people are comfortable with that risk. Generally, what we look for is a diversified approach, either within a portfolio or by utilising investment managers. And many clients will have a range of different investment managers. Within that, there's different styles as well, and we can talk about that at another time, but there's different approaches to how managers apply what their skills are to investing, which again brings different outcomes to portfolios too. Yeah, so when you execute on a portfolio, there's a range of different ways, a range of different styles, and a range of different manager approaches. There's passive approaches, which effectively just buy what the market is in the market weight parcels, and that's had a really good period of time for a number of years now, and that's led by the likes of the CSLs and the CBAs and other large cap businesses that have performed relatively well. But there's also active management styles as well, and those active managers are seeking to find opportunities that will see outcomes that come through differently, or finding growth opportunities before what the market does. And so it's good to have a strategy where you've got a bit of both. Yeah, so you've got a bit of market exposure, which you'll get a market type outcome, and some active exposure as well, where you're finding managers that have got a skill in actually trying to find and invest into opportunities that the market may be overlooking. Bond markets are probably more driven by the government or the political situation at the moment. So you look at yields across 10-year bonds, which is the typical benchmark that we talk about. They were relatively benign in the month. The talk at the moment, as we say, is political, and it's concern around the independence of the Federal Reserve in the US. So here we've got the Reserve Bank, and the Reserve Bank acts independently of the government, and that instills confidence in the financial and monetary situation and set up in the country. At the moment, you've got Trump trying to persuade and influence what's actually going on with the membership there, and you're seeing headlines all the time about his frustration with the Fed not taking action on interest rates and cutting interest rates when the belief is that the economy over there needs a bit of a stimulus. And so that's probably the bigger question, and one that's really interesting and should be closely watched as we move ahead in the next few months and into next year, as Powell's term, I think it's May next year that his term expires. there'll be replacements put in. Some of those are nominated by the president, and so that's of concern. And so that's why you start to probably see a bit more volatility in that part of the market, certainly with longer dated securities, and that's again another element that you can start to pull some levers in portfolios to think about different ways and different strategies of what exposures are appropriate in portfolios. So in the month here and New Zealand, for interest, both cut rates. It's the second cut that we've had in the cycle at this point. Probably a little bit of a delay from what was expected in markets. We're talking July, it actually happened in August. Another meeting is late this month in September. And there's talk whether there will be another cut. I think market's expecting another cut, at least one more cut this year. Whether that happens now or whether there's a bit of a pause to allow the recent cuts to be digested by the economy. Inflation-wise, there's still a little bit of inflation in the system, so that's what the RBA will be watching, and the jobs market here is still very robust as well. So there's still that threat of wage increases, and some of that came through in some of the company results as well. That they're talking about cost impost, so rents which are going up, and wages are still a bit of a pressure point in an economy that's not strong but not weak. So that's something to be monitoring and watching. We did see quite a differentiation, as I said, across sectors, but it also across different styles as well, and that's another lever that we can pull as in decision makers with money. There's different styles, so there's growth styles and value styles and momentum styles that you can deploy when you're putting money to work in the market. August saw a change where the small caps started to perform more strongly, and I think that was a bit of a valuation rotation, that they have lagged markets for a long period of time when you compare small caps and large caps. So large caps had a very good run and small caps really hadn't. And also the growth market, the growth-oriented securities, so securities that are being bought on the premise that they've got greater revenue growth potential or greater profit growth potential in future, more so than a company that may be just sort of bumbling along but looks okay on a price or a valuation perspective. So that was a rotation that happened and has been happening now for a little while, and so those companies that have been out of favour are starting to now get a bit more attention and attraction and leading to better results, whether that be small caps or value oriented type strategies as well.